Okay, this is part 2 to my financial markets video. So here we go. So the money market is a subsection of the fixed income market. The difference is that money market specializes in very short-term debt securities, which is usually less than 1 year. If you ever park your money into a fixed deposit, like a certificate of deposit at a bank, then you probably participated in the money market without you even knowing about it. The money market is also used by governments, institutions, and corporations to raise money in the short term. Example of the money market, investment vehicles is usually treasury bills, again, short-term debt securities issued by the national government, and that goes all the way up to 1 year for maturity. You have your certificate of deposits, a time deposit usually with a fixed interest rate at a time period offered by banks, credit unions, and many brokerage firms. And of course, I know with that, if you try to pull out your money before the maturity, you would actually have to pay a penalty fee, or an early withdrawal fee, which is you being penalized, and of course you're going to lose like the rest of the interest with it. You also have your commercial paper, IOUs issued by corporations at a discount to the face value. You have your euro dollars, a time deposit denominated in US dollars at banks outside the United States, but it has no connection to the euro currency. And lastly, you have your money market fund, a mutual fund that invests in money market instruments like those I just mentioned earlier. So what are the pros of the money market? Well, the returns are very safe. Money market securities are considered extraordinarily safe. If you have no idea where to invest in other asset classes, consider parking your money into these money market securities while waiting for the right investment opportunity to come along. The money market is also extremely liquid. So money market instruments are extremely liquid and can be converted into cash immediately. So what are the cons to the money market? Well, the returns are very low because the money market is considerably low risk. Again, low risk. You can't really lose your money, but if you haven't lose your money, then you're actually going to get a low return. It usually gives you a low single digit return for investors. Which then brings me to the next point. You might lose out to inflation. If your money market instrument is given to you as a 3% return, hypothetically, and inflation is 4%, then you end up losing your purchasing power each year whenever you have your money in that money market investment vehicle. Okay, mutual funds. So essentially, a mutual fund is usually an open-ended, professionally managed investment fund that pools money from many investors to purchase securities. A mutual fund is a type of financial vehicle made up of a pool of money collected from many investors in order to invest in securities, such as stocks, bonds, money market instruments, and all of the assets. Mutual funds are operated by professional money managers who allocate the fund's assets and attempt to produce capital gains or income for the fund's investors. A mutual fund portfolio is constructed and maintained to match the investment objectives as stated in its prospectus. So mutual funds give small or individual investors access to professionally managed portfolios of equities, fixed income investments, and other securities. Each shareholder therefore participates proportionally in the gains or losses of that fund. Mutual funds invest in a vast number of securities, and performance is usually tracked as the change in the total market cap of the fund, which is derived by the aggregating performance of the underlying investments. So income is earned from dividends on stocks and interest on bonds held in the fund's portfolio. A fund pays out nearly all of the income it receives over the year to fund owners in the form of a distribution. Funds often gives investors the choice to either receive a check for the distribution or to reinvest the earnings and get more shares. But if a fund sells securities that have increased in price, the fund has a capital gain. Most funds also pass on these gains to investors in a distribution. Or if funds holdings increase in price but are not sold by the fund manager, the fund shares decrease in price. And the investor can then sell the mutual fund shares to profit in the market. And those are usually the three ways that a investor can actually make money from a mutual fund. Okay, what are the types of mutual funds? So actively managed mutual funds are funds that are managed, again, by an individual or team who selects the fund's portfolio allocations and change them as time goes on. Active funds can take any number of strategies. Some attempted to be a broad market, and others attempting to act as strong hedges against any unforeseen drops or corrections in the market. Some funds have a strong track record of providing stellar returns year after year, but more often than not, these funds will fail to beat their underlying benchmark, making them somewhat of a risk from a investing standpoint. Index mutual funds or a market index fund or just simply an index fund is a type of investment that is considered to be passively managed. The manager of the index of an index fund tries to mimic the returns of an index it follows by purchasing all or almost all of the holdings at an index. So John Clifton, or Jack Bogle, was an American investor. He was the founder and chief executive of the Vanguard Group and is credited with creating the world's first index fund. An avid investor and a money manager himself, he preached investment over speculation, long-term patience over short-term action, and reducing broker fees as much as possible. The ideal investment vehicle for Bogle was a low-cost index fund held over a period of a lifetime, with dividends reinvesting and purchase with dollar cost averaging. There's a lot of indexes, but for every single index, there's usually an index fund that actually mirrors that index. So you have the Dow Jones Transportation Average, also known as the DJTA, or you just call it the Dow Jones Transports. This U.S. stock market index from the S&P Dow Jones indices that actually measures the transportation sector, and is the most widely recognized gauge of the American transportation sector. It is the oldest stock index still in use, even older than its better known relative, the Dow Jones Industrial Average, or the DJIA. Now, the Dow Jones Industrial Average, the DJIA, or just the Dow Jones, or just simply the Dow, is a stock market index that measures the stock market performance of 30 large companies listed on stock exchanges in the United States. First calculated May 26, 1896, the index is the second oldest among the U.S. market indices, after the Dow Jones Transportation Average. It was created by Charles Dow, the editor of the Wall Street Journal and the co-founder of Dow Jones and Company, and named after him was his business associate, the statistician Edward Jones. The word industrial in the name of the index initially emphasizes the heavy industry sector, but over time, stocks from other types of companies have been added to the DGIA. Although the DGIA is one of the oldest and the most commonly followed equity indices, many professionals consider the Dow to be an inadequate representation of the overall stock market because it's just 30 stocks. Established on May 4th, 1957, the Standard & Poor's 500, or just simply the S&P 500, or just simply the S&P, is a stock market index that measures the stock performance of 500 large companies on stock exchanges in the United States. It is also one of the most commonly followed equity indices. The National Association of Securities Dealers Automated Quotations, or Nasdaq, spelled as NASDAQ, Composite Index, is a stock market index that includes almost all stocks listed on the Nasdaq Stock Exchange. Along with the Dow Jones and the S&P 500, it is one of the three most followed stock market indices in the United States. The composition of this index, the Nasdaq Index, is heavily weighted towards companies in the information technology sector. But the Nasdaq 100 includes the 100 of the largest non-financial companies in the Nasdaq Composite Index, accounts for over 90% of the movement of the Nasdaq Composite Index. The Wilshire 5000 Total Market Index, or more simply, the Wilshire 5000, is a market cap weighted index of the market value of all American stocks actively traded in the United States. The Wilshire 5000 is a market cap weighted stock index with roughly 3,400 U.S.-based companies. The index aims to represent the entire U.S. equity market, from tiny 1 million companies all the way up to $2 trillion Goliaths like Apple. And this brings us to the Russell 3000, to which the Russell 5000 is very similar, with the only key difference being the total market characteristic. The Russell 3000 aims to capture the returns of the 3,000 largest U.S. stocks, while the Wilshire 5000 aims to capture the whole entire U.S. equity market's return, regardless of the numbers of issues. So the Russell 1000 is a subset of the larger Russell 3000 index and represents the top 1,000 companies by market cap in the U.S. The Russell 2000 index is a small cap stock market index of the smallest 2,000 stocks in the Russell 3000 index. The Morgan Stanley Capital International, Europe, Australasia, and Far East, also known as the MSCI EAFE, MSCI EAFE Index. Now, this is a stock index offered by the Morgan Stanley Capital International that covers non-U.S. and non-Canadian equity markets. It serves as a performance benchmark for the major international equity markets, as represented by 21 major Morgan Stanley Capital International indices from Europe, Australasia, and the Middle East. And also, you have the Morgan Stanley Capital International All Country World Index, excluding the United States of America, again, which is a market capitalization weighted index maintained by the Morgan Stanley Capital International, MSCI. This is actually designed to provide a broad measure of stock performance throughout the world, with the exception of U.S.-based companies. The Morgan Stanley Capital International All Country World Index, excluding the United States Investment Index, includes both developed and emerging markets. Emerging markets would be Brazil, Russia, India, and China, for example. And developed would be, most of Western Europe. And also, you have your exchange traded funds. An exchange traded fund, or ETF, is a type of investment fund, an exchange traded product. Again, just like the name says, exchange traded funds that trade on exchange. And yeah, they're traded on stock exchanges. ETFs are similar to many ways to mutual funds, except that ETFs are bought and sold throughout the day on a stock exchange, while mutual funds are bought and sold based on their price at day's end. Of course, you have your index ETFs, sector ETFs, and niche specific ETFs. So ETFs are structured for tax efficiency and can be more attractive tax-wise than actively managed mutual funds. Of course, there are actively managed ETFs. Of course, known one of them. Well, the more recent is, at least mainstream, would be Kathy Wood, her ARC ETF. I think that would be actively managed. Yeah, it's actively managed. Unless the investment is sold, ETFs generally generate no capital gain taxes because they typically have a very low turnout of their portfolio securities. While this is an advantage, they share with other index funds their tax efficiency compared to mutual funds is further enhanced because ETFs do not have to sell securities to meet investor redemptions. So here are 4 benefits to owning mutual fund shares. Convenience. Mutual funds are an easy way for the average investor to buy investments, which would be too complex to manage on their own if they're not that educated on investing. You also have the diversification. Mutual funds can own thousands of individual securities that span across various asset classes. And also industry sectors, which gives the investor a broad diversification. Professional management. Mutual funds differ from index funds and that they are managed by experienced industry professionals who follow the fund's stated investment objectives with oversight from the federal government. And fourth and lastly, the investment size. You can invest in small or large amounts of money in mutual funds, even if you do not have much financial or investing experience. So what are the cons of investing in mutual funds? Of course, the advantages are great, but I want you to know 4 more important disadvantages when owning mutual funds. 1, the fees. Well, mutual funds can be expensive to manage, especially those actively managed mutual funds and those actively managed ETFs. So therefore, they charge investors sales commissions, which are called loads, and annual fees regardless of performance. So instead of buying mutual funds through a broker, you can actually minimize fees by purchasing shares directly from a fund family. The share price calculation. Mutual fund share prices are only calculated and made public once per day. Stock prices are updated throughout the day, allowing you to take advantage of a market moment if you trade frequently. Since each mutual fund share is made up of multiple investments, the price depends on the net asset value, or the NAV, of all of the underlying securities. Therefore, if you put in a buy or sell order for a mutual fund, the price isn't set until the official end of the market day. Capital gains. Mutual funds must distribute capital gains to their shareholders, regardless of how long you own the shares. However, if you own individual securities instead of mutual funds, you can control when you sell investments, making it easier to control your capital gain taxes. Longer-term capital gains are taxed at a lower rate than the short-term capital gains. Phantom gains. Mutual funds that need to raise cash can sell profitable investment and create capital gains for investors, even if the fund has performed poorly. This means you can actually lose money on an investment in a mutual fund, and you can still be you can still end up owing taxes. Again, capital gains in a mutual fund gets passed along to its investors. And there's also a index risk. So if you actually invest into an index fund, say the S&P 500 or the Morgan Stanley Capital, International, Europe, Australasia, Far East, and if that index crashes, then so does your investment. So be wary. And of course, if you do invest in the S&P 500, and then if you're trying to add in a company into it, you can't really do that because the index is set. So the holdings in the S&P 500 are already set. So if a company loses its market cap because the S&P 500 is actually large cap, then if it drops down to mid cap for whatever reason, just saying hypothetically, then that company would be taken out. Well, for example, but yeah. Okay, moving on, the commodities market. So a commodity is actually a basic good that can be bought and sold. The purchase and sale of commodities is usually carried out through futures contracts on a commodities exchange. A commodity has no or hardly any differentiation. Like 1 ounce of gold is the same as any other ounce of gold. So examples of commodities would be your precious metals like gold, silver, platinum, palladium. You also have your iron ore. You also have copper, and then you have your agricultural, like your wheat, your rice, your coffee beans, your sugar, your salt, and also corn. So your soft commodities are goods that are grown, while the hard commodities are extracted from mining. And you have your energy commodities like crude oil, coal, natural gas, and electricity. So what are the pros of owning commodities? Well, you do have exposure to different growth opportunities. A growing demand in a commodity can see its prices rise over time. For example, iron ore prices rose by more than 3 times from 2008 and through 2010, driven by huge demand in China and a supercharged economic growth. You also have your diversification benefits. Commodities have historically shown a low or negative correlation to the stock market and the bond market. If you're looking to hedge against your stock and bond market investments, investing in commodities just might interest you. And also, lastly, protection against inflation. While inflation weighs down your stock and bond investment returns, and especially your money market returns, commodities usually benefit from inflation because when the price of goods and services rise, the prices of commodities needed to produce these goods and services will also rise in tandem. So, what are the cons of owning commodities? Well, it's highly volatile. Commodities are one of the most volatile asset classes around. I think in one analysis out there, commodities are twice as volatile as stocks and nearly 4 times as volatile as bonds. This extreme volatility makes commodities risky for certain investors, especially the up-and-coming young investor. And also, there's no income generation. Unlike other asset classes, like you can get income from stocks either through a capital gains or a dividend, or coupon payments, interest payments from bonds, and you can even get interest payments from the money market. Commodities generally don't generate any income for the investor. Moving on to the derivatives market. The derivatives market refers to financial market for the financial market for financial instruments such as future contracts or options that are based on the values of their underlying assets. The derivatives market refers to the financial market for financial instruments such as futures, contracts, or options that generally for kinds of participants in the derivatives markets. In the derivative market, you have your hedgers, your speculators, your arbitragers, and your margin traders. But there are 4 major types of derivative contracts: option contracts, future contracts, Forex contracts, and swaps contracts. Swap, like SWAPS, swaps contracts. Okay, hedgers. Hedging is when a person invests in financial markets to reduce the risk of price volatility in exchange markets, as in eliminating the risk of future price movements. Derivatives are the most popular instruments in the sphere of hedging. It is because derivatives are effective in offsetting risk with the respective underlying assets. 2, you have your speculators. Speculation is the most common market activity that participants of a financial market partake in. It is a very risky activity that investors engage in. Again, it involves the purchase of any financial instrument or an asset that investor speculates to become significantly valuable in the future. Speculation is driven by the motive of potentially earning lucrative profits in the future. Number three, arbitragers. Arbitrage is a very common profit making activity in financial markets that come into effect by taking advantage of or profiting from the price volatility of the market. Arbitragers make a profit from the price difference arising in investment of a financial instrument, such as bonds, stocks, or derivatives themselves. And lastly, number four, you have the margin traders. In the finance industry, margin is the collateral deposited by an investor investing in a financial instrument to counterparty to cover the credit risk associated with the investment. Okay, what are the types of derivative contracts? Derivative contracts can be classified into the following four types. Number one, options. Options are financial derivative contracts that give the buyer the right, but not the obligation to buy or sell an underlying asset at a specific price, referred to as the strike price, during a specific period of time. American options can be exercised at any time before the expiration of its option period. On the other hand, European options can only be exercised on its expiration date. Number two, futures. Future contracts are standardized contracts that allow the holder of the contract to buy or sell the respective underlying asset at an agreed price on a specific date. The parties involved in futures contract not only possess the right, but also are under the obligation to carry out the contract as agreed. The contracts are standardized, meaning they are traded on the exchange market. Number three, forwards. Forwards contracts are similar to future contracts in the sense that the holder of the contract possesses not only the right, but is also under the obligation to carry out the contract as agreed. However, forward contracts are over-the-counter products, which means they are not regulated and are not bound by specific trading rules and regulations. Since such contracts are unstandardized, they are traded over-the-counter and not on the exchange market. As contracts are not bound by a regulatory body of rules and regulations, they are customizable to suit the requirements of both parties involved. And lastly, number four, swaps. Swaps are derivative contracts that involve two holders or parties to the contract to exchange financial obligations. Interest rate swaps are the most common swaps contract entered into by investors. Swaps are not traded on the exchange market. They are traded over the counter because of the need of the swaps contract to be customizable to suit the needs and requirements of both parties involved. Well, what are the cons of participating in the derivatives market? Well, there's a whole lot of risk. The derivative market is often criticized and looked down on, owning the high risk associated with trading in those financial instruments. They're also sensitive to volatility of the market. So many investors and traders avoid the derivative market because of its high volatility. Most financial instruments are very sensitive to small changes, such as a change in the expiration period, interest rates, and etc., which makes the market highly volatile in nature. They're also the derivative market is also complex. Owing to a high risk nature and sensitivity of the derivatives market, it is often a very complex subject matter. Because derivatives trading is so complex to understand, it is most often avoided by the general public. And they often employ brokers and trading agents in order to invest in financial instruments. And lastly, number four, some would say that participating in the derivatives market is legalized gambling. Owing to the nature of trading in the financial market, derivatives are often criticized for being a form of legalized gambling, as it is very similar to the nature of gambling activities, at least by some critics of the derivatives market. Okay, moving on. Foreign exchange market. The foreign exchange market, also known as Forex or abbreviated as FX, or the currency market, is an over-the-counter OTC global marketplace that determines the exchange rate for currencies around the world. The participants in these markets can buy, sell, exchange, and speculate on the relative exchange rate on various currency pairs. The foreign exchange market are made up of banks, forex dealers, commercial companies, central banks, investment management firms, hedge funds, retail forex dealers, and investors. So the foreign exchange market, or the forex market, is of course, that marketplace that determines the exchange rate for global currencies. Of course, it is by far the largest financial market in the whole entire world and is comprised of a global network of financial centers that transacts 24 hours a day, closing only on weekdays. Currencies are always traded up in pairs, so the value of one of the currencies in that pair is relative to the value of the other. So, the foreign exchange market was one of the original financial markets formed to bring structure to bridging the global economy. In terms of trading volume, it is by far the largest financial market in the whole entire world. Aside from providing a venue for the buying, selling, exchange, and speculation of currencies, the Forex market enables currency conversion from international trade settlements and investments. So, according to the Bank of International Securities, or BIS, which is owned by the central banks, trading in the Forex markets averaged to $6.6 trillion per day back in April 2019, which was like literally 2 years ago. Currencies are always traded in pairs, so the value of one currency is in that pair is relative to the value of the other. So this determines how much of country's A currency is to country B can buy, and vice versa. So establishing this relationship or the price for the global markets is the main function of the Forex market. This also greatly enhances liquidity in all other financial markets, which is the key to overall stability. The value of the country's currency depends on whether it is a free float or fixed float. Free floating currencies are those whose relative value is determined by free market forces, such as supply and demand. But a fixed float is where a country's governing body sets its currency relative value to other currencies, often by pegging it to some other standard. So free floating currencies will be the US dollar and the Japanese yen and the British pound, while the fixed floating currency will be like the Chinese yuan and the Indian rupee. Of course, one of the most features of the Forex market is that it is comprised of a global market of financial centers that transact 24 hours a day, only closing over the weekends. As one major Forex hub closes, another hub in a different part of the world remains open for the business. This increases the liquidity available in the currency markets, which adds to its appeal as a large asset class is. This increases the liquidity available in currency markets, which adds to its appeal as the largest asset class available to investors. So, what are the benefits of using the Forex market? Well, there are fewer rules, which means investors aren't held to strict standards or regulations found in other markets. There are no clearinghouses and no central bodies that oversee the Forex market. Most investors won't have to pay traditional fees or commissions that you will probably have to pay on another market. And because the market is open 24 hours a day, you can trade at any time of the day, which means there's no cutoff time to be able to participate in the Forex market. And finally, if you're worried about risk and reward, you can get in and out whenever you want, and you can buy as much currency as you can afford based on your account balance and, of course, to your broker's rules for leverage. Okay, moving on, and the last market and the last newcomer, cryptocurrency. Cryptocurrency, or just simply crypto, is a digital asset designed to work as a medium of exchange wherein individual coin ownership records are stored in a ledger existing in the form of a computerized database using strong cryptography to secure transaction records, to control the creation of additional coins, and to verify the transfer of coin ownership. It typically does not exist in physical form. It's not tangible, like paper money, like a dollar or any other foreign currency. And is typically not issued by a central authority, as in central banks. Cryptocurrencies typically use decentralized control as opposed to centralized digital currency and central banking systems. When a cryptocurrency is minted or created prior to its issuance or issued by a single user, it's generally considered centralized. When implemented with decentralized control, each cryptocurrency works through a distributed ledger technology, typically through blockchain, that serves as a public financial transaction database. And of course, Bitcoin, spelled Bitcoin, first released as an open source software in 2009, which is the very first decentralized cryptocurrency in the world. Since the release of Bitcoin, other cryptocurrencies, also known as altcoins, which is short for alternative coins, have been created. So, what are the pros of cryptocurrency? Well, they say that cryptocurrency is transparent. With Bitcoin, there's an open ledger called a blockchain on which all transactions are recorded and monitored. Because of this, once a transaction is completed and recorded on the ledger, it cannot be changed. Transactions are available for verification by anyone at any time. No one person or organization can manipulate it, and therein lies the biggest security feature. Crypto investors say that inflation is unlikely. All traditional currency experiences inflation because economies shift prices and government continues to print more money. Bitcoin and all other cryptocurrencies do not experience this as much because there is a finite number of mineable bitcoins. It is programmed to only have 21 million bitcoins can ever be mined. Population growth is projected to stop when there are about 10 billion people, which should be by 2050. At least the sources that I'm actually getting this information from. The last bitcoins will be mined around this period, and no more will be introduced into the market. The portability. Unlike physical money, large amounts of cryptocurrency can be transported easily without detection. It is possible to carry billions of dollars in Bitcoin in a memory drive on your person, though not advisable. You also control your currency, at least cryptocurrency. Since the users of digital currency are in control of their transaction, this helps in keeping it safe. Transactions are made independent of the identities of the parties making them. This protects users from identity theft. Transactions cannot be traced. Could be both a pro and a con. The good thing about not being traceable is that there is no fear of any organization monitoring your source of funds. Freedom to buy and sell without the source of your funds being traced is a benefit in many parts of the world. But of course, governments, they might want to monitor you, so that might be a con for them. Okay, cons of owning cryptocurrency. It's subject to market fluctuations. When you want to invest in cryptocurrency, keep in mind that it can be used to buy and sell. It is also a commodity like oil, which is subject to change in market prices. When investing in cryptocurrency, it's best to look at it as a long-term investment and not let momentary fluctuations in price make you think that you probably made a bad investment. But then again, when Bitcoin goes up and down, how is that justified? But at the same time, what are the fundamentals of of owning Bitcoin, or what sector of the economy does Bitcoin actually belong to? Cannot be recovered if lost. Unlike banks that you've covered in case of a security issue like hacking or stolen credit card, Bitcoin are not retrievable if they are lost. There are currently no mechanism to recover lost bitcoins. According to several people, the best way to store Bitcoin is on a drive that is not connected to the internet. This is because they are encrypted for security purposes. The encryption identifies the currency but not the owner. Whoever has the code owned the currency, and this anomaly feature means stolen coins are lost. That is, unless you can steal them back. Transactions made with cryptocurrency cannot be traced. This feature makes digital currency the perfect tool for criminal transactions. Just like drug dealers and other unscrupulous individuals can use cash to avoid detection, transactions made with Bitcoin and others like it are virtually untraceable. This could be a reason for some governments to declare Bitcoin transactions illegal in their countries. Of course, the US dollar is also used for criminal transactions, but the con of this cryptocurrency is still valid. Several people don't understand cryptocurrency in general, and therefore they are mistrustful of it. So digital currencies like Bitcoin are not yet as widely known as they need to be for cryptocurrency investors want them to be. So because of not everybody that knows it, and even fewer people understand how cryptocurrency actually works, people tend to be mistrustful of digital currency. And the number of businesses that accept it as a form of payment are few, at least so far. This is a limitation to people who want to use bitcoins for their day-to-day transactions. Companies are not to blame, however. But adding Bitcoin as a form of payment, you would step first that you have to require to educate your staff about the concept of cryptocurrency and Bitcoin. Other arguments against cryptocurrency. Some people prefer predictive assets like stocks and publicly traded promising companies on a stock exchange, being an early investor in a startup company that will eventually go public on a stock exchange, investing in real estate, microfinance lending. Some people think it's too secretive, and to them, they see it as a scam. Some people say that Bitcoin has no intrinsic value, and the only reason anyone would invest in it is speculation that the price will go higher in order to fight off inflation and the debasement of fiat currencies. It can't be a store of value if there's no value to store. What's crucial with other commodities is that people will always need them regardless where the price goes up. But you can't do anything with Bitcoin if you can't sell it to somebody else at a higher price. Can it go up? Yeah, sure. But what happens when people start thinking it's going to go down? It can also crash just as it easily went up. Other arguments against, cryptocurrency at least, the people's made cryptocurrency is that the US government will probably never adopt a cryptocurrency to replace the US dollar. But at the same time, why would a government like the US financially cripple itself with an artificially scarce currencies when it already has the ability to create as much of its own currency as in the US dollar as needed? Of course, money printing makes the US dollar worth less over time. But still, I don't think that there's no way that the Federal Reserve System would ever allow the success of a competing currency like Bitcoin and all these other cryptocurrencies and altcoins that threaten to put them out of business unless they were behind it themselves. But then again, time will tell if the U.S. government will adopt cryptocurrency to replace the U.S. dollar. And even if it did, wouldn't that cryptocurrency issued by the U.S. government still be fiat? I mean, it is a digital US dollar, but some cryptocurrency investors say that another point of investing in crypto is to be free of government and central banks that control their money. Okay, and that's all I know about the financial markets and how it can build wealth for the native black community in the United States of America. So again, this is Dawson's Discussions. My name is Nathan L. Dawson Jr., and I will see you in the next video. Stay tuned.